Recession 2023, what lies ahead? A recession is a period of economic decline that affects multiple sectors of the economy and lasts for at least 2 consecutive quarters. Recessions are usually caused by a combination of factors, such as inflation, interest rates, consumer spending, business investment, trade balance and government policies. Recessions are a normal part of the business cycle and have occurred about once every decade in the US. Since World War II, the most recent recession was the Great Recession of 2007 to 2009, which was the worst economic downturn since the Great Depression of the 1930s. Many financial experts are predicting that another recession will happen in 2023, due to the persistent inflation and the tightening monetary policy by the Federal Reserve. Indicators and arguments for a recession in 2023. Inflation. Although inflation has moderated somewhat in recent months, it remains well above the Federal Reserve's long-term target of about 2%. The Consumer Price Index, CPI, reading for March 2023 came in at 5% year-over-year, indicating that inflation is still a serious concern for the economy. Inflation has been cutting into consumer spending, which is the single biggest driver of the US economy. Retail sales in March 2023 were down 1.2% from February, and real personal consumption expenditures showed no growth in March. If consumer spending continues to weaken, it could trigger a recession. Interest rates. Interest rates are the cost of borrowing money. They affect the decisions of consumers and businesses on saving, spending, investing and borrowing. They also influence the exchange rate, inflation expectations and asset prices. The Federal Reserve is the central bank of the US. That sets the federal funds rate, which is the interest rate at which banks lend to each other overnight. The Fed uses monetary policy to influence the economy by raising or lowering the federal funds rate. The Fed has been on a steady path of increasing interest rates since December 2022, when it started to taper its bond buying program that was implemented to support the economy during the pandemic. The Fed has raised interest rates by 0.25 percentage points 4 times since then, most recently in May 2023. The Fed's main goal is to control inflation and maintain price stability. By raising interest rates, the Fed aims to reduce money supply and demand in the economy and slow down inflation. However, higher interest rates also have negative effects on economic growth. Higher interest rates make borrowing more expensive for consumers and businesses, which reduces their spending and investment. Higher interest rates also make debt servicing more difficult for households and firms that have high levels of debt. Higher interest rates also strengthen the US dollar relative to other currencies, which makes United States exports less competitive and imports cheaper. All these factors can reduce aggregate demand and output in the economy and lead to a recession. Business investment. Business investment is the spending by firms on capital goods such as machinery, equipment, buildings and software. It is an important component of gross domestic product, GDP, and a key driver of economic growth and productivity. Business investment reflects the expectations and confidence of firms about future profitability and demand. It also depends on factors such as interest rates, taxes, regulations, and technological innovation. Business investment has been falling in the United States since mid-2022, declining by over 8% in real terms over the past year. This indicates that businesses are pessimistic about future economic conditions and are holding back on expanding their capacity or upgrading their technology. Business investment is also affected by uncertainty related to trade tensions, geopolitical risks, and policy changes. For example, businesses may be reluctant to invest due to fears of higher taxes or regulations under a new administration or Congress. A decline in business investment can reduce economic growth potential and employment opportunities in the long run. It can also signal a recession if it persists for a prolonged period. Indicators and arguments against a recession in 2023. GDP growth. GDP is the total value of goods and services produced in an economy over a period of time. It is a measure of economic activity and performance. GDP growth is calculated by comparing GDP from one period to another. GDP growth reflects changes in aggregate demand and supply in an economy. It also depends on factors such as population growth, labor force participation, productivity growth, and technological progress. GDP growth has been positive in the US since mid-2020, when it rebounded from a sharp contraction due to the pandemic lockdowns. The latest GDP report showed that economic growth slowed to a 1.1% annual rate in the first quarter of 2023, well below the previous quarter when the economy expanded by a steady 2.6%. However, GDP growth is still positive, indicating that the economy is not in a recession yet. Employment. Employment is the number of people who are working or actively looking for work. It is an indicator of labor market conditions and income generation. Employment affects consumer spending, tax revenues, social welfare costs, and economic growth. Employment has been rising steadily in the US since May 2020, when it reached its lowest level since the Great Depression due to the pandemic shutdowns. The latest employment report showed that the U.S. economy added 266,000 jobs in April 2023, lower than expected but still positive. The unemployment rate was 4.1%, down from 14.8% in April 2020, when it reached its lowest level since the Great Depression due to the pandemic shutdowns. The latest employment report showed that the U.S. economy added 266,000 jobs in April 2023, lower than expected but still positive. The unemployment rate was 4.1%, down from 14.8% in April 2020. Employment growth reflects the recovery of economic activity and demand in various sectors of the economy. It also shows that businesses are hiring workers to meet their production needs and expansion plans. Employment growth can boost consumer confidence, spending and income, which can stimulate economic growth and prevent a recession. Employment growth can also reduce the pressure on the Federal Reserve to raise interest rates further, as it indicates that labor market conditions are improving and inflationary pressures are easing. The Fed has stated that it will consider a range of indicators, including employment, when making its monetary policy decisions. Trade balance. Trade balance is the difference between the value of exports and imports of goods and services in an economy over a period of time. It is a measure of net foreign demand for domestic products. Trade balance affects GDP growth, exchange rates, foreign reserves and international relations. Trade balance has improved significantly in the United States. Since mid-2020, when it reached its worst level since 2008 due to the pandemic disruptions. The latest trade report showed that the U.S. trade deficit narrowed by 8% to $71 billion in March 2023, the lowest level since October 2019. Exports increased by 6% to $200 billion, while imports decreased by 1% to $271 billion. Trade balance improvement reflects the recovery of global trade activity and demand after the pandemic shocks. It also shows that U.S. exports are becoming more competitive and diversified, while U.S. imports are moderating due to higher domestic production, substitution effects and lower oil prices. Trade balance improvement can boost GDP growth, as net exports contribute positively to aggregate demand. In conclusion, the U.S. economy is facing a high risk of a recession in 2023 due to the persistent inflation and the tightening monetary policy by the Federal Reserve. However, the recession is not inevitable, and there are some positive signs that could prevent or mitigate it, such as the positive GDP growth, the rising employment, and the improving trade balance. The outcome of the recession will depend on how the economy responds to the various shocks and challenges it faces, as well as how the policymakers and market participants react to them. The recession could be mild and short-lived, or it could be severe and prolonged. The best way to prepare for the recession is to be informed, flexible and resilient. By understanding the causes and effects of the recession, we can make better decisions and take advantage of the opportunities that may arise from it. If you enjoyed this video and want to learn more about the economy and finance, please hit the like button and subscribe to our channel. We post new videos every week on topics such as inflation, interest rate and more. Don't forget to turn on the notification bell so you don't miss any of our updates. Thank you for watching and see you in the next video.